Hey guys, my name is Peyton and welcome to a new segment here at Remax Property Group. It's going to be Financial Friday. So at the end of every single week, we'll be checking in about 5 to 10 minutes. Just giving you an update, mainly focusing on the housing market here in Houston, but also just covering a broad spectrum of the economy as a whole and any updates that you might have missed out on and kind of seeing where it might play out in the future. And of course, we're going to be starting off right here with what everyone's been seeing in the headlines. Talking about the seller's market run-up that's been going on for the past few years, and obviously narrowing in on that catalyst of 2020, that being COVID mixed with the Fed's regulations on interest rates and printing endless money, because who doesn't love that? This black swan event being COVID brought upon many changes, especially with the government buyouts, the changes with stimulus and interest rates, kind of speeding up the process of the housing market and throwing it in a big loop that no one could have expected. This leaves many of the buyers and sellers wondering what to do in their position. Does a seller's market necessarily mean that it's an adverse market for buyers? So the first aspect we're going to look at is fairly straightforward. It's just going to be increasing the supply. But instead of looking at, for say, completed construction month by month, which is going to show you the current added value of supply, we're going to take a look at the housing permits that are registered. So that way it's going to show you kind of a future prediction of the housing that's going to be built later down the year. So looking at this chart here, I will point out that this trend line is going to be a 3-month moving average. So we do see right here in 2020, two pretty solid peaks here, right about the middle of the year and then down towards the end, right before it dips off into 2021. So we take a look here at this dip that carries into our current year, and notice that even still after that, the forecasted trend line is going to be showing increasing all the way through July of 2021. Remember, this is going to be the housing permits, not the completed construction. So having permits increasing all the way throughout July will bring supply throughout the end of the year. And of course, a lot of that construction finishing up possibly early 2022, which will alleviate a lot of the supply shortage that we're seeing here in Houston. An increase in supply would end up being a complete and utter waste if it weren't for anyone wanting to still buy that and keeping the demand up. Obviously, that varies a lot on consumer sentiment. One thing that holds true in any consumer market is that economic outcomes are the aggregation of the decisions of the individuals based on limited data from major media. With everyone having an opinion or biased on the market in terms of how it is right now, where it might be headed, whether that's a positive or negative outlook, puts a large spin, especially whenever you're dealing with house sales that are going from one consumer to the other. With the power of the consumer having such a large influence in the real estate market, we do have to pay attention here to the news sentiment. Kind of gives you an idea of what the actual consumers are getting fed, whether it's good news, bad news. So here we do have a scatter plot graph, and that's also going to be showing a trend line right through here in the middle. It's going to be a 60-day average. You see here in the middle of 2020, we do see a little bit of a negative dip. And then after that, it starts to work its way up and has been staying positive for a little bit. So here in Houston, we are predicted to have an increase in supply coming along throughout the year, along with showing positive consumer sentiment. So you do have the supply to purchase, and then you have a positive belief in that market. The only thing we're missing now is going to be the third application, and that's going to be the financing. And that seems to still not be a problem at all, as we witness interest rates still maintaining a very low holding, and actually back on April 8th, decreasing for the first time since February as we watch the bond yields go down. As of right now, the Fed is supposed to be holding interest rates from what they say is supposed to be through 2023. Obviously, no promises on that. But if that's a possibility, we're looking at a long time of artificially low interest rates that give a very, very strong buying opportunity. Getting a view here of the interest rates for mortgages all the way back since the 70s. We can kind of see the craziness that it's gone through, and ultimately coming down and down as we progress from what was about the 80s. Here we're going to be looking at a couple examples just to show you the difference in opportunity cost. Looking at the difference between these loans, you'll notice that everything is the exact same. Home value is the same, loan amount, down payment percentage. The only difference you're going to see on both of these 30-year loans and their fixed rate is going to be the interest rate, and it's only 1 point difference. But looking here at the totals paid across the lifetime of the loan, can see that single point of difference on the same exact home value is going to make a $50,000 difference. And then right here, kind of similar example, but instead of simply just changing the interest rate and seeing the different payments, this is, for example, if you were trying to keep a $1,300 monthly payment, showing what you could be able to afford with a 20% down payment based on your interest rate. So obviously right here at 3.2%, you're sitting all the way up at a $300,000 house. You can afford keeping that $1,300 monthly payments. Here, if we bump it up to just 1% higher at 4.2, you now knock off 40 grand from your home value. So the max you can purchase with that same 20% down payment is going to be $260,000. Taking advantage of the low interest rates while you can, with future value in mind over, of course, the slightly higher down payment and the slightly higher home value that you're purchasing. A lot of these opportunities in the long run will end up paying off higher in your yield if you're able to secure a low interest rate. So those examples are great at drawing a clear and distinct line in between upfront cost and future value, which is sometimes hard to see, especially whenever a home purchase is usually spread out over a 30-year mortgage. Is all of this for certain and guaranteed? Of course not. Is there positive data to show a growing housing market over the future in Houston? Yes. Is financing cheaper than it's ever been and still makes up for the disadvantage of an increased house price on most cost basis? Yes. So with all this information on the current seller's market, where does this leave a buyer? Do they buy or do they not buy? Obviously, it's going to come down to a personal decision and really just depends on your financial position. You could either talk to an agent or a financial specialist to see what fits you and your future goals. So as we've stressed, the biggest thing whenever going to look at purchasing a home is understanding and thinking of that home in terms of future value. A home is a buy and hold investment, and over the long term, that volatility of the market really is just going to play itself out. The housing market has proven itself to be resilient, separate from a lot of the market turndowns time and time again, and there's a reason that it's one of the strongest and longest holding investments to ever have. That's all we have on today's Financial Friday. Feel free to either message me or comment any questions you might want to have answered. We'll see if we can figure those out for you. And we'll see you right back here next week for Financial Friday here at RE/MAX Property Group.